Hey, Sam.
Hello, Tamo. Good afternoon.
Good afternoon. Hey, Nathan.
Hello, Tamo. How are you?
I'm good. I'm good. I think William will join in a couple of minutes. He's just getting ready. So we will start with you, Sam.
Yep. So I will first talk about the crypto market,
Yeah.
and then I will pass on to Nathan for ECNY, and I'll come back for the stablecoin and banking. Then it will be all the way down.
Okay. So I don't need to come in every interval and connect you guys. You guys will pass like a relay race. You'll just pass to each
Yep.
other.
Yep.
Excellent.
Yep. Sure.
Excellent. Good afternoon, everybody. We will start at 4:01. Just give one more minute to everybody to sort of settle in.
Hi, mucho.
Okay, let's get going. Good afternoon to our friends and colleagues on this, what I promise is to be super interesting webinar, our quarterly effort on digital assets. We publish a quarterly, and also for certain accredited investors, we also publish a monthly. And we tend to follow three things: cryptocurrencies, the world of stablecoins, and of course, the world of central bank digital currencies. In all three areas, there have been major movements in the last 3 months. So my colleagues, Samuel Say, Nathan Chow, and William Chung are here along with me to go over their findings of the very latest report. We will be able to post a link to the report, right, gentlemen? Sam, the
Sorry.
report is
Yes.
ready, right? We can post a link
Yep.
to the report on the chat.
Yep. We'll post it on the link to the chat later on during the presentation.
Okay.
Yep.
All right, good. Excellent. So I think we all know what's been going on with the crypto universe, and of course my colleagues will talk about that in detail. I will just share one personal take on the recent developments. Crypto wallets, not just cryptocurrency, crypto wallets have been seen as a super safe area to, or vault, if you will, to keep your savings. Absolutely no chance of people knowing your key, and even if they do, it'll be pretty obvious, who's taking your stuff because of the blockchain and the trail. But given what happened with the Chunzi saga in Cambodia last year, when the US authorities managed to seize this crypto wallet and basically take out $16 billion worth of Bitcoin, which of course in all recorded history, the largest heist ever, largest seizure ever of an individual's wealth, I think has been a bit of a sobering impact on the crypto community. There are many other conjunctural developments on the regulatory side, on market development side, on what's happening on the equity side, and you'll hear our colleagues talk about that. But I think that this particular incident, which we have not really referred to in the report, in my view, has also been a major source of nervousness for many crypto investors about the sanctity of their holdings in crypto wallets, because nobody really knows how the Americans got into that crypto wallet and how on earth they managed to take all that money out. And on the world of stable coins, my colleagues in this report have really delved into an absolutely fascinating, but at the same time inevitable tussle that is taking place between the establishment, by that I mean the banks, who benefit from a fractional reserve system, who inject money and credit to the economy through the multiplier money multiplier system, their interest versus the free for all, let money be fully democratic, and anybody should be able to issue stable coins as long as they have a backing of a safe asset. That world, I think, it was inevitable, and it's really taking place, despite the fact the Trump administration being such a big cheerleader of all things crypto and stablecoin. So with that in mind, I think we need to sort of take stock of what is happening in the world of stablecoin and separate the feverish speculation and excitement from the nitty-gritty of how monetary regimes work, how much control do monetary regulators want, and the role of banks in the financial system. I think some profound questions are coming up. I think we can say with high degree of confidence one thing: the established is not going to see this position very easily. With that in mind, let's get the slideshow going. I think my colleague Samuel Say will kick off the presentation. Sam? Go ahead with your slide presentation, all yours. Oh, and before Sam starts, one more thing. This is a WebEx webinar. There is a chat function. Please feel free to post your observations and comments there. I'll keep a tab on that. And through the course of this call, we will address some of those questions as well. All right, Sam, go ahead.
Thank you, Tamo. Good afternoon, everyone. Thank you for joining the webinar today. So in this section, I will go through the market updates for the crypto market, and then Nathan will talk about the ECNY, and then Wei Liang and myself will also talk about the stablecoin development moving forward. So let's get started. So for the crypto market, as we all know, the crypto market has seen a market correction over the past 2 months, which BTC and ETH lost around like 20-30% of the value. But it's a good timing to have this event today, because the market also rebounded overnight. Like BTC back to like 68,000 before the webinar started. So basically what is happening right now is that there is a strong outflow from the ETF over the past 2 months. And then if we look at the fear and greed index for the chart on the right hand side here, we can also see that the index has been at the historical low at around 5. So since 2018, there were around 6 to 7 times that this greed and fear index fall to around 5. And then market started to recover. But in any case, there is a lot of liquidation from the market. Let's say if we look at the market data, there is a total liquidation of $6.6 billion over the past 2 months from the crypto market. So what is driving the market sell-off over the last 2 months? We think the key reason is that the correction, or the simultaneous correction of the software companies. So over the past years, when we look at crypto, we always think crypto is a risk asset, and it is highly correlated with the US stock market, which is, yes, this is the case. So if you look at the table on the left-hand side here, on the top left here, you can see the correlation between Bitcoin and S&P 500 or Nasdaq at around like 0.89, 0.87 over the past 3 years. But then if we look into the detail of the stock market, in fact, Bitcoin has an even stronger correlation with software specific companies, because these are, software companies are high beta stocks, and also, they look at the future. A lot of, innovation are at the core of these, asset class. So that's also the reason why Bitcoin moved closer to software companies than the high headline stock market. And in fact, over the past 2 months, the stock market, there is some correction, but was largely resilient. Hardware company is doing fine, and also the old economy like energy stocks are doing fine. But what really, plunged over the past 2 months is actually the software company, which there is some earnings worries, and also the other worries over the volatility and liquidity as well. So if we compare the crypto market and the tech stock, in fact, they share a lot of similarities. For example, like the crypto, they doesn't have intrinsic cash flow versus the tech stocks, especially the software companies. They have a long duration on the future cash flow, as well as their stock price are depending on the future growth or the innovation. These are very similar to the crypto markets, and that's why they are moving alongside with each other. And especially when the market is now estimating more bond issuance from the software company, and these kind of market news are weighing on all these sentiments over the tech related asset class, including the crypto markets. So in fact, aside from the overall risk-off sentiments from the crypto or from the from the stock markets, there is another concern over the overall liquidity or monetary condition and geopolitical tension. These are also fitting through into the sell-off of the of the crypto market. So if we look at the chart on the left hand side here, we can see the Bitcoin price and the real yield, they are moving in opposite direction. So the reason is, I mean, it's very clear. When the liquidity is tightening, then there is the capital will be flowing out from the riskier asset, including the crypto market. So what is happening right now is that first, geopolitical risk is intensifying. Second, there is a renewed tariff measure under Trump. And then also from monetary condition perspective, the next cut will be likely materialized in the second half of this year. As the US economy is still fairly resilient. There is some sign of slowdown, but at this stage, it is still resilient. Let's say if we look at the fourth quarter GDP data, it is slightly it's below the market expectation, but it was also largely due to the shutdown of the US government. So with all these, the rate cut will only happen in the second half of this year, and this is also pushing the real yield higher as well. And also there is rising term premium over the US economy, especially when we have a lot of worries over the US fiscal situation, when the Trump administration has to return the tariff to the importers. So I mean, the kind of term premium is not just confined in the US, but actually the global term premium is going higher as well. So with that in mind, the overall real yield in the fixed income market is getting higher, and this is also fitting through into the downward pressure of the cryptocurrency. So but with all these, we have seen some rebound in the crypto market, as I have mentioned. So there are still some positive news. For example, there is ongoing inflow from the institutions. Reportedly, there is an Italian bank, one of the major players, has already stacking up the Bitcoin over the past few months, and also another US giant financial institution are stacking up the Ethereum for the future staking as well. So with all these inflow, there is a clear support on the crypto markets when the sentiment went to extreme fear condition. And also in the future, there will be still some development from the crypto market, especially on the Ethereum. There will be a hard fork this year, and there will be the staking is also getting improved. So all these are supporting the crypto market development moving forward. So that's why we can see there is a strong selling force over the past 2 months, but at the same time, there's still some, market participants coming in, support the market, and that's why the crypto market just started to rebound over the past few hours. So, so for the next, thank you. So for the next section, I will pass on to Nathan to discuss the ECNY.
Thank you, Sam. Afternoon, everyone. Let's talk about the Chinese digital yuan, the ECNY. So for a long time, if you follow ECNY developments, the PBOC has been carrying out a lot of experiments for quite a while. We heard about the red envelopes in Shenzhen, right? it was distributed by local government, then you can use it to buy a coffee, to buy a donut, right? And there are also some, different kind of pilot programs in Shanghai and the athletes as well as foreign tourists using the ECNY at the Winter Olympics 4 years ago, right? But so far, it always felt a bit experimental. However, as we move into 2026, that has changed officially. Okay, we have now entered what the PBOC called the ECNY 2.0 era. First of all, let's put the scale into perspective. As of late 2025, the ECNY recorded a cumulative transaction value of about 16.7 trillion yuan, just like what you can see on the chart here, the left chart. Okay, so this is exponential growth. This is a massive number. So it tells us that this is not a toy, this is not a trial anymore. It is increasingly becoming an important part of China's financial ecosystem. And it is moving fast into the world of big businesses and cross-border trades. And here's the biggest change that happened on January 1st this year. The ECNY started to pay interest since January 1st this year. Okay, so before this, the ECNY was treated like cash, digital cash, what we call M0. But right now, since January 1st, it is officially a digital deposit or M1, M2. So think of it this way. Before, it was like a digital balance, digital banknote in your wallet that just sat there, right? But right now, for the first time, if you have a real name wallet, as long as you have a real name wallet, that money actually earns interest. It is currently around 0.05%, and that is exactly what you can get from a standard bank account. So this makes the ECNY also a savings tool, not only a spending tool like before. So for commercial banks, I would say this is a significant change because these digital balances are now on their balance sheets as deposits, meaning they can finally integrate the ECNY into their regular credit creation and asset management. What happened before was that if you move your money to an ECNY wallet, that money actually left the commercial banking system, but it is no longer the case right now. And the ECNY deposits are also covered by the National Deposit Insurance right now. So in practical terms, there is not much difference compared to regular bank deposits. So basically, the PBOC has made the digital yuan just as safe and just as useful as the money in your regular bank account, but with all the speed of a digital token. Of course, next slide, please. Running a shift this massive on a national scale definitely needs a serious backbone, right? So that is why they have recently launched 2 specialized centers, both under the Digital Currency Research Institute of the PBOC, the People's Bank of China, in order to manage the whole operation. One in Beijing, they have set up an operations and management center in Beijing. Their job is domestic security, making sure the data is safe and keeping the tag running for 1 billion people without a hitch. And then they have also set up an international operations center in Shanghai as well. So the center in Shanghai is all about internationalization. They handle the cross-border clearing and make sure the ECNY can talk to other countries' digital systems. In other words, put it simply, Beijing keeps the house in order while Shanghai takes the currency global. But of course, while Shanghai looks outward, the real task of the 2.0 era is how this money is being used for everyday people and businesses right here at home in the mainland China. A lot of people have been wondering and they have been asking if the CNY will replace Alipay or WeChat Pay. Actually, no, the answer is no. It is, in fact, living inside them. You can hold your digital yuan right there in those apps and use it for morning coffee or your online shopping. Okay. Another important 2.0 innovation is the B2B sector, the business to business sector. Commercial banks right now in China are now using something called industrial smart contracts. Imagine a company orders a shipment of steel. With a smart contract, the ECNY payment is automatically released the second the digital delivery is verified. No more waiting days for checks to clear or manual work to move. Okay, it is automated. It is instant. It's saving companies a ton of time on their liquidity. Okay, and this efficiency is not stopping at the border. Of course, it is being also exported to the rest of the world through a massive infrastructure, and that is the mBridge project. Next slide, please. So for anyone new to the name, mBridge is the platform where different central banks trade with each other directly. It's been scaling rapidly, processing over $55 billion so far year to date. Okay, and get this, the ECNY makes up about 95% of that volume. The BIS, the Bank for International Settlements, used to be a key partner early on, but they stepped back in 2024. Once they stepped back in 2024, mBridge effectively became a purely sovereign-led system. So the participant countries like China, the UAE, Thailand, Saudi Arabia have since then taken the wheel. They are now using peer-to-peer real-time settlement to trade commodities, trade oil, trade gas, without touching the traditional slower clearing systems. So I would say it is basically a parallel rail for a multipolar financial world. Moving on to next slide. We have some latest regulatory measures regarding the development of digital space in China. Because Beijing wants to make sure this all works smoothly, the government is keeping very tight grip on the digital ecosystem. Just a couple of weeks ago, like early February, they put out a major new directive called the Notice on Further Preventing and Resolving the Risk Related to Virtual Currencies. So the directive basically banned any private company from making their own RMB-pegged stablecoins. And it also banned tech firms or marketing agencies that help offshore crypto entities. And on top of that, they cracked down on tokenizing things like real estate and securities in the mainland China. So at the end of the day, it's all about preventing money laundering and reducing the risk of capital outflows. So I would say this approach is very different from what we are seeing in other parts of the world. For instance, the US and Europe are busy building frameworks like the Genius Act and MiCA to facilitate private stablecoins. Wei Liang and Sam will talk about this in a minute. But I would say the PBOC is, on the contrary, clearing the field, right? The message is very clear. If you want digital yuan, you use the official one in China. They have taken the best part of crypto, of course, the speed, for instance, and the 24/7 settlement, and folded them into a safe, state-regulated environment. Okay, so that's pretty much the latest development of the ECNY. Looking ahead, as we look at the 15 5-year plan, the goal is very clear, which is to bring even more partners into the mBridge network, especially across ASEAN and BRICS regions. And as far as challenges are concerned, I believe the regulators want to make sure commercial banks, especially smaller banks, do not run out of cash as more and more people move to digital wallets. But anyway, the path is set. The ECNY 2.0 is not just a pilot project anymore. It is playing a bigger and bigger role in the Chinese digital economy. So that's it from me. I'll now pass it over to Sam and Wei Liang for the latest stablecoin development.
Thank you, Nathan. So in the next section, we will talk about the stablecoin, which is somewhat related to the CBDC that Nathan just mentioned. So So recently there is an interesting report from the Federal Reserve, which we would like to share with our audience today. So for the Federal Reserve, recently issued this report to discuss the impacts of stablecoin on the wider banking system. So to recap, with the stablecoin, previous Genius Acts, the U.S. government is now requiring the stablecoin issuer to that the reserve should be backed up by one-to-one U.S. Treasury bills or by cash. So for now, we can see for some of the major stablecoins, most of them being backed by the U.S. Treasury. And then some of these kind of reserves are also backed by deposit or secured loans. But moving forward, they will be backed up by either cash or the U.S. Treasury. So what is for the impact on the U.S. Treasury is that we have to segregate the inflow from both domestic or from foreign inflow. So for foreign inflow, it is more like a capital inflow into an economy. So for example, when there's an increase in stablecoin market size, and then if it is a foreign inflow, then there will be exchange of FX in the US dollar stablecoin, and there will be inflow in the US Treasury bills, and that's why lower US Treasury bill yields and US dollar will strengthen. But if it is a domestic inflow, the situation will be a little bit different. So that means there is a swap between a US dollar deposit into US dollar stablecoin, then the bank holds less deposit and therefore less reserve, and therefore they may have to sell the US Treasury bills or US Treasury bonds. And then the stablecoin issuers, they will buy the US Treasury bills, so that will offset the outflow of US Treasury bills from the banks, but that cannot offset the outflow of US Treasury bonds because the regulation requires stablecoins issuers to own the short-term bills, highly liquid short-term bills. So that's why we should see a steepening curve of the US Treasury, and the US dollar strength will remain largely steady given this is just a domestic inflow. So how about the deposit? Because deposits is what really affects the banking system. So here we first look at the deposit and then the credit and then also the regulatory requirements. So for the deposit side, let's say there is an increase in stablecoin market, and then there will be a swap from retail deposit into stablecoins. Let's say I am a retail market player, and then I swap my deposit into a stablecoin, and then that means the stablecoin issuer now owns my deposit, and then the stablecoin issuer they are actually a wholesale deposit player. So that means their deposit characteristics or their functionality is a little bit more price sensitive. Let's say if Bank A and Bank B, there's Bank A and Bank B. Bank B offer a higher interest rate, and then the wholesale deposit player, which is a stablecoin player, will move to Bank B for the deposit. So they are less sticky in terms of deposit. So banks have to raise the interest rate, the deposit rate, to attract these kind of less sticky deposits. So what is the impact onto credits or onto loans? Is that the funding cost is higher, and because as I've mentioned, the banks have to raise the deposit for these stablecoin players, and also this kind of liabilities to the bank is a lot more riskier, right? So the long duration assets become less attractive in this sense, because if my funding cost is higher, I may not want to borrow so much, lend so much money to to long-term projects. And also at the same time, internally, there will be a higher fund transfer pricing, which is the FTP. So that will also impact infer a higher loan interest rate moving forward for the clients. So in that sense, with higher rates, then that means the loan volume will decrease. And with the higher deposit rate, the NIM will also compress as well. And adding to that, regulatory requirements plays another important role here. Let's say for Basel III, we have the LCR, the liquidity coverage ratio, and also the net stable funding ratio, the LCR and NSFR. So these kind of requirements, they are requiring more liquid asset or high quality asset, when the deposit base or the liability is become less sticky for the bank. So let's say for the LCR, they will require more high quality liquid asset to encounter short-term stress, and for the NSFR, it will require some more available quality asset to encounter some long-term stress or durations and risk. So with all that, the interest rate will be going up for both deposit, credit, loans, and also internal interest rate as well. And then the loan volume will decline. Deposit will also decline. So that is the the overall impact of stablecoin issuance over the banking system at a glance. So in the next section, I will pass it on to Wei Lan to discuss the stablecoin and AI. Thank you.
Okay, thank you, Sam. So it seems like it's a very academic discussion, why the impact of stablecoins on banking sector, but this has very serious consequences from a macroeconomic point of view. So there are policy implications because of that. So one risk that stablecoins introduction pose will be the risk of disintermediation from banks. So for instance, when deposits start to shift from banks out to stablecoin issuers and to US treasuries, then that necessarily means some degree of a contraction of the money supply due to a money multiplier effect. And it has as we have seen during the 08-09 global financial crisis, when the banking system is not functioning well, that's going to have a net social loss for the economy. So that also brings us to the debate between the US banks and the US crypto companies with regards to the policy around stablecoin rewards, right? So there has been a little bit of a hold up in terms of discussions in the Senate for the market structure bill, which is also called the Clarity Act, because of a disagreement with regards to stablecoin remuneration. And this have very important policy implications because it could lead to more financial instability. So our bias is that the US likely to lean towards prudence. But bringing it back to Asia, what are the implications for Asian economies, especially Singapore and Hong Kong, which are two economies that are poised to roll out stablecoins? Hong Kong has already passed the stablecoin ordinance. Singapore is formalizing rules around stablecoin. So what is the impact that we should be worried about? So based on the academic research that we know that Sam covered earlier. So we look at it from three different angles. And here I must stress that we are independent researchers. We are not representing the point of view of the bank, but we're representing what research is saying about the situation for these two economies. So in the case of Singapore, Hong Kong, one thing to note is that they are both countries that have historically very low fiscal deficits. And because of that, the stock of government bills are relatively low. So because of this circumstance, you could say that there's very little risk of deposit disintermediation when since the stablecoin issuers, they have to take the inflows and park them with the banks. So in aggregate, we will expect very low risk that deposit volume is going to shrink. But does that mean that there's no impact? Not necessarily the case, because the composition of deposits is the one that will change quite a bit. So what happens now is that we could see deposits moving from retail, somewhat sticky funding towards more of wholesale nature due to the deposits now being parked by stablecoin issuers. That can lead to some penalty to the stable funding numbers. So it could lead to a little bit of impact on the liquidity coverage ratio, net stable funding ratio, as Sam mentioned. So that means that we could see some more prudent lending decisions because of that. So because of the fact that funding costs has become a little bit higher, and also funding situations a little bit more short-term because of the wholesale deposit nature. So we could see a shift away from longer duration loans. And just one final point is that even if we take out the risk of disintermediation, does that mean that banks probably will be okay? And actually, some academic papers are saying not quite the case, because there will be some degree of competition on the liability sides, right, between banks' deposits and stablecoin liabilities. So what it means is that the resilience of the banking sector as a whole could be somewhat weaker, because now your interest margins for the banks is going to be a little bit more compressed, and that really affects the ability of banks to be able to restore any credit losses during downturns. And these credit losses, they don't really apply at all for stablecoin issuers. So there could be some impact on the resilience of the banking sector as a whole, depending on how widespread stablecoin adoption is. But by and large, given that Singapore and Hong Kong banks, they are all in very strong capital positions, they're all very highly well regulated, we don't expect too much of an impact coming through. Although from theoretical point of view, yes, capital positions could be somewhat impacted because of stablecoins. So going to the next slide. Does that mean, with all this risk to financial sector's stability and so on and so forth, does that mean that we should actually shy away from stablecoin usage? I think this really implies a trade-off between an emerging innovation versus the existing financial rails, right? So emerging innovation is pointing towards a need for more open, a more resilient, and also a more digital kind of financial system for the future. And cryptocurrency networks are exceptionally well placed to serve that role, whether it be in the case of digital payments, where you have cross-border payments from countries being settled with very low cost, very high efficiency, and very high availability. You also have upcoming innovations in two very important areas. You have, for instance, tokenization. We have seen increased volumes of tokenized real assets being put on blockchains. They have grown three or four times over the last year. And also at the same time, we have this up-and-coming innovation called prediction markets, where you can bet on outcomes of elections, or you can bet on outcomes of sporting events. And these are all happening not on traditional financial rails, but on crypto networks. And last but not least, in 2026, I think we could say that AI is the defining theme of the year. We already seen that coming through in SaaS companies being disrupted because of emergence of AI. Would the same risk of disruption happen for cryptocurrencies? Actually, I would argue that AI is more of a complementary technology for DeFi, rather than one that's as disruptive for DeFi. So if you imagine a world where AI agents, they can use stablecoin wallets to make transactions, right? They can procure goods, they can pay for services from restricted endpoints. And even now, we have this, just recently, we have a so-called AI agent marketplace, where they can actually hire humans to do physical tasks, because AI agents, they don't exist in the virtual world, right? They can't go and pick out a parcel, they can't make deliveries, and so on and so forth. So you have AI agents now creating jobs, right? Being paid for the services of humans. So it's a very interesting world, one that's very different from what has come before. And with the increased AI participation, what do we expect? We should be expecting higher utilization of cryptocurrencies, higher utilization of digital wallets built on blockchains. Why is that? Because A, there's no other alternative, right? Cryptocurrency blockchains are the dominant technology infrastructure. They are already being used for these purposes. They are open, so they are very easily accessible, and they're globally used. They're not just restricted to certain geographies, like for instance, case of RMB. Maybe you can argue that it will be very, very prevalent in China, but outside of China, not quite clear how that will turn out. So we look at the data from University of Cambridge, and they track the amount of stable coin flows based on wallet addresses across the world back in 2024. And given the predominance of US dollar stablecoins, you would expect that almost all the flows would have gone to the US or come out of the US. But that's not quite the case, because actually the data shows that only about a quarter or less of flows originate from or goes to the US. That means about 75% of flows are going to other countries, between other countries outside the US, even though they are actually using the US dollar stablecoin. So that means, that really speaks to the advantage that the stablecoin ecosystem provides to everyone. It's not just US-centric development, it's actually available right now for developers to build, for developers to use, to create new applications that would define the next generation of financial applications. So that's one very promising area. And if that's the case, what do we expect going forward? Given the rise of AI agents, even more users coming to the cryptocurrency networks, we should be seeing actually a rise in usage metrics, and that's exactly the case right now. So if you look at the daily active addresses count, and that's one of the wonderful things about cryptocurrency networks, is because everything is open, you can actually track the data. How many active users are there every day? How many transactions are being done on these networks? And the data shows very clearly, you can see the average daily active addresses have risen, and they're very close to hitting the 2021 highs. Remember back then, it was during the pandemic, everyone was locked in their homes, and digital speculation was really all the rage. And now, even now, with volatility being as high as it is, with speculative sentiment being as low as it is, we still see very high amount of active addresses growth. So it speaks to the utility of cryptocurrency networks. And the transactions count, that's really through the roof. That has gone to a record high, and most of the jump actually happens in the last 6 months or so. We see about 70 to 80 million monthly transactions in the first 2 months of this year per month, and really the February record, even though we're not at the end of February, is already higher. We have seen higher amount of transactions in cryptocurrency networks in this February compared to all other Februaries, even back during the heydays where everyone was really speculating on crypto. So the users are coming to crypto. We also see changes in some of the in some of the technology front runners of the day. So in the US, we're starting to see more applications being developed in crypto. So for instance, Kalshi, which is a prediction market exchange, they just recently launched tokenized contracts on blockchains, the Solana blockchain, allowing prediction market users to make bets basically on decentralized infrastructure. And also in the US, there's a famous venture capital startup incubator called Y Combinator. They're famous for backing Airbnb, famous for backing Stripe, and they have actually started issuing their founders, to the startup founders, the option of actually getting the startup cash in the form of US dollar stablecoins. So they are putting money where their mouth is. They have said last year they are working with Coinbase Ventures, with Base, to try to fund more startups in 3 major areas. A, in stablecoins, B, in tokenization and in trading, and the last area they're funding is really in AI agents. And that's coming together to show the power of really AI technology together with crypto technology, producing new exciting potential for next generation financial infrastructure. So with that, I would pass back the timer to conclude.
Thank you, Wei-Liang, very much. A couple of questions. Question number 1, Byron wanted to know if will CNY eventually kill the private payment giants? I said my answer is no, but I'll let Nathan address it.
No, I do not think so, because we're gonna remember this. This is not a zero-sum game. Okay, the PBOC strategy is interoperability, not replacement. So yes, it is true that the ECNY wallet right now is offering interest 0.05% interest, right? But Alipay, WeChat Pay, they're offering massive lifestyle ecosystems, loans, insurance, social features. So think of it as a 2-layer system. The ECNY provides the safe interest-bearing vault or settlement rail, while the private apps like Alipay provide the user interface. Yeah, so no, the answer is.
Right. I also think that the generalized scope for CBDC type transaction and the scope for fiat money transaction, at the end of the day, they start blurring. Because if you think about how money is created, it is created electronically. It is the way central banks allow commercial banks to put reserve, and through the fractional reserve system, it gets created into high-powered money. There isn't actually money printing and money going to vaults of banks and that being turned out, that doesn't really happen anymore. Nobody's deposit comes in cash. Similarly, loans are not sent out in cash. So we are living already in an electronic world. The question is, can the central bank issue certain amount of base money straight into the hands of corporates or individuals, just the way we have received in Singapore during the pandemic and also every single year now, basically time-stamped money, which we call here community development vouchers, but they have an expiry date. You don't use it, it goes away. And it's digital money in its pure form. Issued straight. Actually, in the case of Singapore, it is something that is underwritten by the Minister of Finance. The fiscal angle is also very clearly demarcated. But you can go, in theory, one step further and basically the central bank, just as helicopter money, as anything, ESGD, EUSD, ECNY, and so on. Till Donald Trump came to power, I also thought that the US was going in that direction, that the Fed Now account was going to create a system where Americans will join the fray with their fellow Indians and the Chinese. Both in the Indians and the Chinese have leapfrog into the world where they can receive direct payment from their government into their accounts. They can do real-time settlement just like institutions can because the interbank infrastructure has become so well. If the US doesn't have such a good infrastructure, maybe the blockchain infrastructure was going to be the solution around that. Now, of course, focus has shifted to cryptos and stablecoins. So I'm not really sure on EUSD is around the corner, but I think we can all safely say the ECNY is certainly real and will go strength to strength. Then there is a question from Wang. If the ECNY stays on bank balance sheets, like you said, why are small banks still worried? I think this question is also for Nathan, right?
Yeah, well, so what I mean is that in the 2.0 era, like what I said, money stays on the commercial bank's balance sheet, right? So the risk is more of a digital flight. So think of it this way. In the old days, moving money from a small rural bank to a giant bank like ICBC or BOC, that took time and effort. It was a hassle. But right now, it is just one tap. So people can move their entire balance from a small town bank wallet to a big four bank wallet or an Alipay link ECNY wallet, right? So small banks are not losing the money to the central bank anymore. It's not losing their money to the PBOC anymore. But they sort of, see a risk of losing it to their larger competitors. So in this sense, they gotta work much harder now to keep their deposits sticky. For instance, like offering more value-added services or differentiated products. Yeah.
Nathan, I recall a few years ago when the Silicon Valley bank crisis took place, exactly the same discussion took place in the US, which was that the moment within the internet across certain blogs, panic about Silicon Valley Bank spread, people began to take their money out just with the tap of a button going from one bank to the other bank. And the run was actually a digital run on Silicon Valley Bank. You didn't actually have hundreds and hundreds of people standing online trying to withdraw their money, which is the typical picture of a bank run. You can have bank run much more easily now because of the ease of transfers. Again, this doesn't have to be an ECNY or anything related issue. In the US, we don't have any E, but it can happen just because the banks have become very digital and transfers through the real-time gross settlement system, something that was available for commercial banks in the past. Now the transfers are very, very easily done over the internet through internet banking by anybody. So the risk of small banks getting disintermediated by big banks, in my view, is a more of a financial technology-driven risk as opposed to a ECNY versus fiat CNY risk.
Exactly. Agreed.
Okay, next question. What would be the implication for, another ECNY question, ECNY development in terms of our long-term positive view on crypto, such as the Bitcoin Trust or Ethereum? Well, Young, why don't you take this?
Right. So the impact of ECNY, I think China is so big that it doesn't really matter what the rest of the world is doing. Even the rest of the world has settled on crypto market infrastructure. ECNY will still exist, right? Because effectively China, they have banned the use of all virtual currencies, and not without cause, because the risk of virtual currencies, especially with regards to the circumvention of capital controls, that's quite serious for China. So ECNY will be here to stay because China is such a big economy, and by and large, all the tech companies in China would say they're building and gearing their applications towards the ECNY. So that's I think you could say it could be a situation that's a bit similar to Galapagos Islands, where you can see your own evolution of apps in a relatively single location, whereas the rest of the world is moving the opposite direction.
Well,
But
yeah,
by and
the
large,
difference is this Galapagos Islands has 1.4 billion people.
yes.
Also, I think the other decision would be that Galapagos was, very, very far from any sort of civilization, and hence the cross-pollination or crossbreeding could not happen. China now is increasingly embedded into the global economy. So the Chinese using ECNY eventually, in my view, would have spillover impact on many countries that do trade and commerce with China.
Exactly.
I want to point out one thing, because the second half of this question says, our long-term positive view on crypto, that with respect to Bitcoin, those of you who have read our digital asset quarterlies or monthlies on a regular basis, you have seen the long discussions that we have had on this thing, particularly the regulators' concerns, and including BIS, which sort of has these 3 criteria for money, the divisibility, the sanctity, and so on, that somehow or the other, neither crypto nor stablecoins sort of meet those tests. I have been reading a different critique lately, and I'm sort of persuaded by that to some extent. And it doesn't have to do with cryptos in general, but Bitcoin in particular, which has this fixed 21 million token supply. And then the critique is that money in nominal terms grows with the economy, with the population, with activities, and so on. If Bitcoin does not, by definition, have the mechanism to grow with the global economy, then inherently it sort of, if it is widely used, it'll actually have a disinflationary or deflationary impact, because its quantity is fixed. There are times when you want to increase quantity to absorb demand. Otherwise, you create, asset price distortions. And there are times when you want to take some liquidity away if the global market is overheated or inflation is a big problem. Bitcoin doesn't allow you to either way, because by definition, it doesn't have a regulator which uses a discretionary policy decision. I find that argument fascinating, and I'm surprised that in the past we haven't seen the BIS or the IMFs come up with that argument. William, what do you think of that critique?
So if you look at the look at a multi-decade view of the money stock, right? So it has always been growing consistently over the last 50, 60 years since the and I think the growth has even accelerated somewhat after the peg to the gold standard was dropped. And that's really an outcome of economic reality, right? You cannot be pegged. You cannot allow your unit of account to be pegged to basically a static quantity, because it no longer serves the purpose that's supposed to serve, which is to act as a stable unit of exchange, right? So ultimately, it proves deflationary to have the dollar pegged to the gold standard. So that was done away with, and that's also why Bitcoin will never, I think, in my view, will never be able to be served as that unit of account, because it is effectively a rigid supply. It doesn't react to the needs of the economy, as well as the people in the economy. So that's one view around it. But if you look at it from the point of a store of value, actually that's different, right? So because we know that gold has been historically a very good store of value, that's really an interest for investors, and in the very long run, with the money base always in a state of expansion. I mean, even in Japan during the lost decades, the money base was expanding. It's just not expanding as fast as in the other countries. So that fixed supply is more or less, I would say, an argument for a having a store value property to Bitcoin. But of course, at the same time, if economic circumstances change, when you actually need the supply to be contracting, for instance, in this case, when Bitcoin prices have fallen so much, Some people are asking for U.S. Treasury to come in and buy out Bitcoin and reduce the supply, but that's not going to work. So you will have to bear to some extent the degree of volatility in the short term because of fluctuating demand and supply conditions. But by and large, in the long run, I think the store of value argument is still largely intact. Because of the fact that you have no discretion in setting monetary, rather in this case, Bitcoin supply. And I think to the extent that it speaks to the original intent of Bitcoin, which is not to have any kind of human intervention, not to have any kind of potential bias being introduced into something that people would like to hold as store value. I think that's still pretty attractive, even though you lose the flexibility of something that's actively managed.
There you go, digital gold. I will end today's webinar on that note. Sam, Nathan, Well-Young, thank you very much for your contribution. And we have provided the link to our report already on the chat, so please do take a look at it. Thank you, everybody, for joining this call. And until next time, everybody stay well, stay safe, stay healthy. Bye-bye.
Bye.
Thank you. Bye-bye.